All right, good evening. Welcome to another session that we have to look at a consolidated statement of financial position. So my name is Kelvin Capote. I'm an accountant. So a licensed member of Zika, hold a bachelor's degree in accounting and finance. I'm a certified credit professional and a finalist in the Chartered Accountants Zambia program. So today I want us to, and I come representing our company, which is Ventures Tax Corporate Services. So we continue from the previous lecture that we have, which introduced group account. All right, so the key takeaways from this lecture is that you should be able to prepare consolidated statements of financial positions for a single group. You should be able to deal with NCI, both at fair value as well as a proportionate method. You must be able to describe and apply accounting requirements for goodwill. You must be able to consolidate reserves. You must be able to deal with intra-group transactions, and you must be able to deal with the effects of fair value at consolidation. So these are the key takeaways from this lecture. If there's anything else that you need to learn in order for you to consolidate the balance sheet, these are the things that you have to look at. Okay. So let's start with the basic principles of consolidated statement of financial position. So a consolidated statement of financial position is basically achieved by, doing the following. So by consolidating the financial position statement, you are basically adding the assets and liabilities of the parent and the subsidiary. Okay. Then the next thing that you must then deal with is intra-group transactions are excluded from the consolidated statement of financial position. Then only amounts owed by or to third parties are included in the consolidated statement of financial position. The investment in the subsidiary shown in the parent statement of financial position is replaced by the net assets of the subsidiary. So at consolidation, the investment that you see in the balance sheet of the parent company must be eliminated and replaced by the net assets of the subsidiary. Then the cost of investment in a subsidiary is effectively cancelled by the share capital and reserves of the subsidiary. So basically, those are your net assets, right? Finally, the consolidated statement of financial position only shows capital of the parent. So when you consolidate the statement of financial position for a group, the only capital that is shown is that of a parent. Okay. So in order for you to consolidate the balance sheet, you need to deal with the big four things, right? So there are things that you need to understand. You must be able to deal with these big four items. But before you deal with the big four items, you must first start by establishing the group structure. So basically that gives you about 5 key workings that you must do. Okay, so you must make sure that you do at least 5 key workings. So the first working that you do is establish the group structure. So that will be your working number one. You can't consolidate without understanding who owns who, which one is a subsidiary and which one is the parent. So first you must be able to understand who the parent is and who the subsidiary is. When was the parent acquired? When was the subsidiary acquired? Okay. And what is the percentage of the NCI? Does the parent own 100% or the other portion is owned by other investors? So that must be established through what is called the group structure. So what I'm showing on the screen here is a group structure. So you've got the parent there who is then who acquired a subsidiary at a particular date. So in this group structure, it basically shows that P owns 80% of subsidiary S. All right. And so the other 20% then is owned by other investors. So that is the first working that you must do. The question is going to give you guidance on how you're going to establish the group structure. The question can either give you can either say, the parent owns 80%, or they can give you a proportion of the shares that were acquired from the subsidiary, and you must work it out. There are different ways that you have to use to determine, the percentage of ownership in a subsidiary. So then we start with our big four, which will be then working number 2. Very important, okay? So the first item of the big four is what you are calling the net asset list, okay? So you must be able to establish the net asset list. The net asset list is a very important calculation because the following calculation, which is the calculation of goodwill at acquisition, is based on the the second working, which is the net asset list. So on the screen, what you can see is you're able to see 3 columns, right? Other lecturers will just show you 2 columns, but I prefer to show you 3 columns so that you are able to understand what is happening. So you've got a column which says at the acquisition date. All right. And then you've got another one that says at the reporting date. And then after that, we've got the post-acquisition what? The post-acquisition column. So you can see that you've got the share capital. So we're basically just getting the net assets. All right. So this is the share capital and the reserves of what? The reserves of the subsidiary at the point that we acquired. All right. So that's what we want to establish. What was the value of the net assets at the acquisition date? What is the value of the net assets at the reporting date? And then what is the movement in the net assets of the subsidiary? This is what this working basically addresses. So you can see that we've got the share capital there. So the share capital at the reporting date and acquisition is basically the same. So you've seen that the post-acquisition, there's no movement there. Okay, so this usually does not change. When this can only change if, for example, there were some shares that that were sold. Okay, so if basically you are dealing with F7 or your CA 2.1, these are rare cases, unless you are dealing with 3.1 or dealing with your SBR. So you would find those, mid-year, disposal and all those things. So usually at 2.7 or CA 2.1, you find that the share capital remains the same at the acquisition date and at the reporting date. Reserves. So the share premium equally, you see that there's no change there. So we basically have a change on the retained earnings and the revaluation reserve. Okay, so retained earnings, when you acquire an entity, then post-acquisition, you understand and you agree with me that that business will continue trading. So as it continues trading, it is generating profit, right? So if you acquired it on, say, 1st June, there will be a post-acquisition retained earnings that will be recorded in the next 6 months. So those post-acquisition retained earnings are basically the difference that you are going to have in the post-acquisition column. All right. The same applies to revaluation reserve. So you can have some changes in the revaluations of the assets, either upwards or downwards. So those are recorded at the far end column there. The other things that can feature in this working are things to do with fair value adjustments, okay? So if you've got some fair value adjustments, those fair value adjustments will feature in this calculation. And then where you have a fair value adjustment, you're also going to have the aspect of what? Depreciation that has to be dealt with, or amortization, depending on what asset has been revalued, and then that fair value aspect comes into play. Okay, so if you have a tangible asset, then you need to deal with, a depreciation. If it is an intangible, you have to deal with amortization. Then the other aspects that can come here is the issue of provision for unrealized profits. Okay, so the provision for unrealized profits is going to feature here in an instance where the parent, the subsidiary transfers an asset to the parent. Okay, so that when the subsidiary transfers an asset to the parent at a profit, that profit will have to be dealt with in this fix. We have to adjust those because that is an intra-group transaction. So basically, this is what you find on the net asset list. So the next screen that you see there, now let me just highlight something here before I even move on to the next screen. Because what I've basically done is explain what is happening there. I've actually explained the next screen. So the first column, which says at the acquisition date, okay? So the net assets at the acquisition date is the column that you are going to use in the calculation of what? Goodwill, okay? So you are going to use that one in the calculation of goodwill. That is why it is very important that you understand the net asset list, you understand how to calculate it and how to interpret it, and then understand how to use it in the calculation of the next big four item. Okay. So I think I've explained the first the columns there. So we're saying that the increase and decrease will be split between the parent and the NCI according to their ownership of percentage. So what we are talking about in terms of the increase and the decrease is the post-acquisition reserves, right? So the post-acquisition reserves will be shared amongst the controlling interest as well as, or rather the parent, as well as the non-controlling interest in accordance with the percentage ownership of the subsidiary. So the post-revaluation surplus for the parent is added to the total revaluation reserve according to the sharing percentage. Okay. Then the other working that you then have to deal with when you're consolidating the balance sheet is the goodwill calculation. So goodwill calculation, the goodwill that we are talking about here is an acquired goodwill. Okay, so the goodwill that you acquire at the acquisition date. We're not talking about the internal generated goodwill here. So we're talking about the purchased goodwill. All right. So this is how you are going to calculate the goodwill. So you get the purchase consideration at the fair value that represents the parent. So you're basically going to look at the money or the transaction value that the parent transferred to acquire the subsidiary. Then you're going to add the NCI value at acquisition. So you're going to value the NCI, okay? So the NCIs can be valued at either using the fair value method. So the question will basically tell you whether the parent uses the fair value method to value the NCI, or they use the proportionate method. So whichever method is being used is what you're going to use here. So when you add the value of the parent, the fair value of the parent consideration plus the NCI at acquisition, that would give you the total value of the net assets of that particular the total consideration that was paid by the parent to acquire that particular subsidiary. Then you're going to compare that with the fair value at acquisition date. So the fair value at acquisition date, you've seen I've put working number 2 there, W2. It signifies that that value is going to come from the first working that you did, which is this value here. So this value here is the value that you're going to get and insert there to compare with the consideration price that you paid. So when you get the consideration price and then you remove the value of the NCI, the net assets at acquisition date, you're going to have a goodwill on acquisition. So this is the goodwill on acquisition here. All right. So this would be a goodwill on acquisition here. Now, there are certain times when goodwill can be impaired, right? So basically, goodwill is just the difference between the consideration and the net assets. So if your consideration is more, the net assets are less, then that difference is basically, so you're paying for the goodwill of the company, right? If you don't understand the aspect of goodwill, I'm going to post another lecture on intangible assets where I'm going to explain what goodwill is and the types of goodwills that we have. So the one that I'm talking about here is a purchased what? It's a purchased goodwill. So this figure here, which says goodwill on acquisition, is the goodwill that you are calculating. But if goodwill is impaired in that particular year, the question is going to tell you to say goodwill was impaired by so much. So if it was impaired, you're not supposed to remove the impairment of goodwill. So remove impairment. Then what you're going to remain with is what we call the carrying goodwill. Okay. So you're not going to take this value to the financial statement. You're going to take this value as your goodwill to the statement of financial position in your consolidated statement of financial position. So this is what you're going to then get. Okay, so this is what we call the carrying goodwill. Then after having after having calculated your goodwill, you have to move to the next big four. So we've dealt with two big items that you need to do. That is the net asset list and the calculation of goodwill. So now let me just help you understand how you determine the value of the NCI. Okay, so if the question tells you to say the NCI are determined at the fair value, or the group uses the fair value method to determine the value of the NCI at acquisition, then you are going to use the NCI value is going to be the number of shares. Okay, the number of shares held by the NCI multiplied by the subsidiary share price. Okay, so you get the number of shares that are held by the NCI multiplied by the subsidiary share price. The subsidiary share price that you're going to use is the market value. So the market value of the subsidiaries is the subsidiary shares is what you're going to then use to multiply by the share so that you get the actual value. So if NCI is calculated using the proportionate method, so you're basically going to get the percentage. So if I own 20% as the non-controlling interest, so you just basically get 20% multiplied by the fair value, the fair value of the net assets, or the net asset fair value at acquisition. So you multiply by that figure in working number 2 in the first column, and that will give you the value of the NCI. So you can either use those two methods, all right? So if you decide to use, if the question says you use the fair value method, then goodwill has to be shared. So the impairment of goodwill has to be shared. So if you're using the fair value method to determine the value of your NCI, then the impairment of goodwill has to be shared between the parent and the NCI on the basis of their percentage ownership. Okay, but if you're using the proportionate method and goodwill is impaired, then what you're then going to do is you're only going to allocate the impairment to the parent, okay? So the impairment is only going to affect the parent, and it won't affect the NCI, okay? So goodwill can either be positive or negative. So if your net assets are lower than the consideration you've paid, then you're going to have a positive goodwill, okay? But there are certain times where you find that the consideration you paid is less than the net assets of the subsidiary. So in that instance, you find that you're going to have what you call a negative goodwill. So a negative goodwill doesn't really mean it's a bad thing. The standard calls that as a what? As a bargain purchase. So if your net asset value is say 200,000, and then the owners of the company sells that company to you at 150. What you have actually done is you've actually earned the 50,000, because you are supposed to buy the net assets of that particular company at 200, but now you've been given that that company at a bargain. All right, so you've bargained well, you've saved some money. That is why it's called a bargain purchase. And since it's a bargain purchase, you actually take it to the group retained earnings in working number 5. Okay, so you're going to add it to the group retained earnings in working number 5. But if it's a positive goodwill, then you're going to capitalize the carrying goodwill in the consolidated statement of financial position. So that is how you deal with goodwill. All right, so now let's look at the other aspect, which is then the non-controlling interest. How do you then determine the value of the non-controlling? So this is working number 4. In terms of the big 4, this is the big 3. This is item number 3 of the big 4. All right, so non-controlling interest is basically calculated by the NCI value at acquisition in working number 3. So the NCI value that you calculated in working number 3, the time that you were doing your goodwill, is what you're going to put then. All right, and then you're going to add the NCI share share of the profit, the share of the post-acquisition reserves. Okay, so remember working number 2 now, the post-acquisition movement in the fair value of the asset. Okay. So that post-acquisition movement in the post-acquisition retained earnings is what you are going to do. What is what you are going to include there? So that is going to come from working number 2 from your net asset list. So add those two numbers, and then if the NCI are then valued at fair value, if they are valued at fair value, then the NCI share of impairment will be deducted here. So you're going to less the NCI share of impairment. Remember, this is only done where if the NCI are determined using the fair value method. But if it is a proportionate method, don't remove the impairment. So it will just be the first one, so it will be the NCI value at acquisition plus the NCI share of post-acquisition reserves. Then that will give you the NCI value, which are then going to take to the consolidated statement of financial position. But if you're using the fair value method to then determine the value of the NCI, then the share, the NCI share of that, the impairment loss on goodwill will have to be removed from this working. And then the final figure is what you're going to take to the consolidated statement of financial position as a component of equity. Remember in the previous video, I said the NCI are accounted for under equity in the consolidated statement of financial position. All right. Then the final working that you have to do in terms of the big four is the group retained earnings, or it can be called the consolidated reserves. Okay. It can be called the consolidated reserves, or it can be called the group retained earnings. So that is working number 5. So these are the key workings that you then have to understand. All right. So how do you calculate this? So the parent retained earnings. So the parent retained earnings, you basically get them from the financial statement of the parent at 100%. You slot it there. Then we are going to get the parent share of post-acquisition retained earnings. So the parent share of the post-acquisition retained earnings, you've seen working number 2. So it's coming from the net asset list calculation that we did in the first place. So that post-acquisition reserves, we are going to apportion it according to the ownership between the CI and the NCI. Then we are going to less impairment on goodwill from working number 3. So the goodwill that we calculated, that impairment of working in the third calculation, we are going to apportion it according to the parent's share of that impairment. So after doing that, then we are going to calculate the group retained earnings. Remember, I said we can also deal with things like provision for unrealized profits here. If the parent transferred, because the first one I said is the subsidiary transferring to the parent, right? So the subsidiary would have recorded a profit. But now in this case, if, for example, the parent sells an item of non-current asset to the subsidiary, the parent is going to record a profit in their accounts, all right? So when such a thing happens, remember intra-group transactions have to be cancelled. So we are going to eliminate that. So this is a point where we adjust those transactions. So we are going to remove that profit. We are going to calculate the profit and then remove it from this particular working. The other thing that we can deal with is also we have to deal with the depreciation aspect if the parent, transferred those items to the subsidiary. Then the other item that we can then deal with here is also provision for unrealized profit can be dealt with in this working. So you need to understand what is happening, who's selling to who. Okay, provision for unrealized profit, we have to deal with it. We can deal with issues to do with unrealized profits on non-current assets as well, or unrealized profit on inventory. So we need to understand all those aspects. So you deal with those things in this working. So colleagues, these are the big things that you have to deal with if you are to be good at the consolidation of financial statement of financial position. If you don't understand these 5 workings, consolidation will be difficult for you. And I know people complain, so no, consolidation is difficult. It's just that you can just fail to manage your time, but in terms of the application, you get the principles that you're supposed to use in an exam and practice as much as you can. I think that's one thing that kills us, is we fail to practice, because consolidation needs you to practice so that you understand, okay, who's transferring the property, who's transferring inventory, and where do I take this, which working should I slot these changes in. So these are the key things that you then have to deal with and understand in the consolidation of the statement of financial position. All right, so goodwill, I did explain what this goodwill is, and then treatment of goodwill. So in terms of the treatment of a positive goodwill, so positive goodwill is capitalized as an intangible non-current asset. So you basically capitalize an intangible non-current asset in your consolidated statement of financial position. Then the standard requires you to test, goodwill annually for impairment. Okay, so you should be testing a goodwill annually for impairment. The standard does not permit the amortization of goodwill. All right, so the standard does not permit the amortization of goodwill. All right. So in terms of impairment of goodwill, post-acquisition. So how do you deal with the impairment of goodwill? So what I've basically given you in this slide is what I was explaining in the other slides, where you see that goodwill is going in working number 5, it goes in working number 2. So this is basically now me putting the accounting, treatment, or posting the transaction according to so this is the bookkeeping, part of the goodwill transaction. So where you've got an impairment on goodwill, all right, so what you're going to do, if you're using the proportionate method, I said you don't involve the NCI in the proportionate method. Don't include Tawafishibe, don't include them in that, all right? So the proportionate method, what you're just basically going is you're going to debit the group reserve, and credit goodwill, okay? So by debiting, remember, the group reserves, this is income. This is basically your profit. So this money, it's a component of equity, basically. So when you debit it, you're reducing, okay? So that's why we are subtracting. So when you debit it, you're reducing. And then when you credit goodwill, so remember, goodwill is considered as an asset, okay? To increase an asset or to add an asset, you basically we debit. But now in this case, we are crediting goodwill. So meaning we are showing that we are removing that impairment loss from the goodwill account, from the asset account. So if you're using the proportionate method, that is how you are going to account for goodwill. But if you're using the fair value method, debit group reserves with the parent, the percentage attributable to the parent in working 5. So if you can remember, you bring it in working 5 here. This is where it comes there, where it says less share of impairment. Okay, so debit group reserves with the percentage attributable to the parent, okay, in working number 5. Then debit the NCI, percentage attributed to the NCI in working number 4. All right, so you have removed it from working number 4. And then credit goodwill in working number 3. I hope that's clear. So debit reserves, debit the NCI, and then credit goodwill. Then you would have accounted for goodwill according to the consolidated statement of financial position. Treatment of negative goodwill. How do you deal with negative goodwill? So negative goodwill arise when consideration transferred is less than the fair value of the net assets purchased. All right. So if the consideration transferred is less than the fair value of the net assets, then we are going to have what you call a negative goodwill. I explained this concept, or a bargain purchase. All right, so you're going to have a bargain purchase. So IFRS 3. So IFRS 3, colleagues, is business combination. Okay, so it calls this as a bargain purchase. So it doesn't refer to it as a negative goodwill. We use the word negative just to try and address the point here. Okay, so but the standard IFRS 3 refers to this or calls this as a bargain what? Purchase. So if this is the case, then the fair value of the net asset and liability arm is, this may be the case where the fair values of the net assets and the net assets and liabilities of the subsidiary is maybe misstated. So if there was a misstatement at the time that you were transacting, you find that you can have a situation where your net asset then exceeds the what? The consideration transferred. So in order for you to verify this, you must recalculate. Okay, so you must do a recalculation. And if you recalculate and quite all right, you find that yes, the fair values were okay and they were not misstated, and we are having a negative goodwill, a bargain purchase, then the bargain purchase is credited to the statement of profit or loss. So by crediting, you are increasing the profitability of the group. So you take that to working number 5 and you include the negative goodwill or the bargain purchase in working number 5. I hope that is clear. Then you are going to have what we call the pre and post acquisition reserves, right? So the pre and post acquisition reserves. So pre-acquisition reserves are reserves existing in the subsidiary at the date of acquisition. So at the date of acquisition, you're going to have some reserves in the company. Okay, so you're going to have some reserves in the company. These are called pre-acquisition reserves. So you basically, as a parent, the new parent of this subsidiary, you basically don't have the rights to the pre-acquisition reserve. The pre-acquisition reserves belong to the previous owners of the subsidiary. You have rights to the post-acquisition what? Profits. Because remember now, so the question is going to give you to say at the time that you were acquiring a subsidiary, the reserves or the retained earnings were at so much. Then now you need to go in the balance sheet and get the post-acquisition and then compare, then that will give you the movement. So that movement is now what is going to be shared by the new owners or the new parent as well as the NCI. All right. So they are capitalized at the end of the acquisition by including them in the goodwill calculation, quite all right. And post-acquisition profits are profits made and included in the retained earnings of subsidiary following what? Acquisition. I think I've explained that point, and I don't need to belabor that. So these post-acquisition profits are the ones that are then shared between the parent and the NCI. So now let's look at the pre and post-acquisition reserve. So basically the same concept, applies here. So the group reserves. So when looking at reserves such as revaluation reserve, distinction must be made, right? So reserves that existed at the date of acquisition and the increase or decrease in reserves post-acquisition date. So you need to distinguish between the pre-acquisition reserves and the post-acquisition reserve, just like you did on the pre-acquisition retained earnings as well. So post-acquisition reserves of the subsidiary is included in the group reserve in the statement of financial position, with the remainder being added to the NCI. So if there's a movement in the pre-acquisition reserves, that movement needs to be shared between the parent and the NCI. Okay, so that is how you deal with that. The concept of non-controlling interest, I think I did belabor on that point when I introduced a group accounting in the first lecture. So where the parent owns more than 50%, say 80%, this means that there are other shareholders or investors having a stake of 20%, and these are called non-controlling what? They are called non-controlling interest. So as such, the parent will control and direct the subsidiary. So the fact that the parent has more than 50%, they assume control and direct what? The subsidiary. Okay. So the accounting treatment of the NCI, how do you deal with the NCI? I think I did explain that the NCI are accounted for as part of what? As part of equity. So in the consolidated statement of financial position, so CSFP, I'm referring to consolidated statement of financial position, okay? So include all of the net assets of the subsidiary to show control, right? So you must include all the assets, the net assets of the subsidiary, so that you show control that okay, the parent controls all the assets here, right? Then give back the share of the net asset belong to the NCI within the equity section of the consolidated statement of financial position. So then you are going to split equity in accordance to the percentage ownership of the parent and the NCI. But this is dealt with in the equity section of the consolidated statement of financial position. Fair values, all right? So you need to deal with fair values. When I was talking about the net asset list, I think I did mention the issue of fair value adjustments, okay? So fair values are basically, examined in an exam. So they will give you to say, okay, at the time that the parent was acquiring the subsidiary, so assets were not accounted for. The value was this. So when you just hear such things, you need to make sure that now you factor in those fair values. So those fair values usually comes when there's issue of revaluation happening at the time that they're consolidating, right? Or at the acquisition date. So such things may be missed. So where they realize that, okay, so these were not accounted for, we need to account for them. So when there are fair value issues, you need to deal with that particular amount. You need to incorporate it in the value of the asset. And then you need to deal with the depreciation or amortization that then affects that particular transaction. Okay. So that's why we are saying to ensure that an accurate figure is calculated for goodwill, consideration paid for a subsidiary must be accounted for at fair value. The subsidiary identifiable assets and liabilities acquired must be accounted for at fair value. So need to pay attention to those fair value adjustments. Now let me deal with the cost of investment as well. So let me deal with the cost of investment. So there are different ways that you can use to then acquire a subsidiary. So you can either pay by cash, so you can pay, it can be a bank transfer where you transfer to acquire a subsidiary, or it can be done using the fair value of any considerations, deferred or contingent consideration. So when you talk about a deferred consideration, so a deferred consideration is a transaction where, so we are selling this. Let's assume that this book here. Let's assume that this book is being sold at 100,000. Okay. For just for argument's sake. So this book is being sold at 100,000. Then the person who's selling me the book, we agree to say, okay, I'm going to pay you 50,000 today, cash. Okay, so I transfer 50,000 today cash, and then we agree to say the other 50,000 will be paid in 2 years. So I'm going to transfer 25,000 next year, and the other 25,000 will be paid in the other year. So now, this is a deferred consideration. So the second half of the payment is deferred. It's going to be in future. Now, that the fact that the payment is going to be in future, colleagues, then we are bringing in the issue of financing, the finance costs or interest. So now we need to discount that 50,000 at the company's cost of capital. So we need to determine what the cost of capital will be. So what that basically means is, for me not to pay you, I'm actually creating a financing, I'm actually creating a financing within myself, because I was supposed to give you that money, but now I'm returning that money, I'm using it for something else. So it's the same as me going to the bank and borrow money, which I can use and then pay in 2 years. So that transaction is basically the same. So now looking at that and the fact that there's the issue of time value of money, this particular person would have used the 50,000 today to buy a number of goods. So now, because of inflation and all those aspects, we need to make sure that now we account for that financing aspect. So that is what we call a deferred consideration. I think we are going to look at that when you start looking at questions. And then the one that we have is the other one that we have is a contingent consideration. So a contingent consideration, contingencies is where we agree to say, okay, certain things must be done in order for me to pay you this. So we can agree to say this company is worth 100,000. I'm going to pay you 90,000 cash, but the other 10,000 I'll only pay you if it generates the profits that you said the company can generate. Okay, so you said this company has got a capacity to generate sold profits. So I'm only going to pay you if it generates those profits. So now what is happening is I've promised that I'm going to pay. Okay, I've promised that I'm going to pay the 10,000. So it is a contingent liability. I may pay, I may not pay, depending on the outcomes of that particular transaction. So that is what is called a contingent consideration. Then the other option is what we call the share exchange. Okay, the share exchange. So share exchange is where I can transfer shares from my company to the other person to acquire stake in that company, or we can exchange shares where I transfer 3 shares and then I get 2 shares, right? So that is a share to share exchange. So such transactions also happen in order for you to do what? To acquire a subsidiary. I want you to note one thing according to the standard here. Incidental costs of acquisition such as legal, accounting, valuation, and other professional fee must be expensed. So these fees are not part of the consideration or the purchase consideration of subsidiary. If you incur an accounting fee, a legal fee, or valuation fees and all those professional fees, these must be treated as expenses at acquisition. So you must expense them at the point that you're consolidating the subsidiary. Issue of debt equity associated with acquisition. So issues of debt equity associated with the acquisition. So if you are going to issue some debt equity, those costs are not part of the consolidation. So you don't consolidate them. You deal with them according to the provisions of IFRS 9 and IAS 32. So for today, let's end here. This is where we end with this particular part. I'm going to take you into next time that I come, I'm going to bring a question that we must do, you and me, so that you then understand how to deal with the share-to-share exchange. So this is the question that we are going to do the next time that I record this session. So just make sure that you keep checking my channel so that you don't miss out this. Please share my videos and invite others to subscribe to my channel. For those that have subscribed, please share so that your friends can also benefit from this lecture. Thank you and have a good night.